So what options do businesses have?
So I think, look, I mean, first and foremost, there's the cash you have and the control you have over that. We spoke a lot about optimizing working capital and OPEX. I mean, that goes back to the matrix control, what was in your frame. The second aspect around that is where you have external sources of financing, so banks, etc. There has been a proclivity with banks to effectively roll interest payments, etc. So, anything that's contractually agreed, and this includes rent, what we've seen is many people have gone and renegotiated those contracts. So it's not even just about optimizing what's in front of you, it's changing the terms of engagement. All of that ultimately facilitates and improves the cash pool that is in front of you. I think, again, also many businesses have effectively gone the route of asking key suppliers if they would upfront provide payments for lower cost, right? So if you were on a SaaS model, do you go to your customers and say, look, we'll give you an annual license fee, but at a 30% discount if they were sufficiently cash flow? So I think that's, again, with the kind of key view of do what is in your control to do, and think kind of, very broad about how you can do that. I think then once you kind of get outside of that and you think about, well, let's say new sources of capital to your business, whether that's, debt or mezz or equity or, even kind of grant related aspects around that. And I'm going to take kind of, let's say, the government stimulus packages off because those would be very specific to each country. And I think you're right, Darren, in Africa, they are quite limited. I think I would say that, probably quite comfortably, you're not going to get a new investor that you've never spoken to before to invest in your company within a 6-month time frame today. The truth is, I think with the travel ban is going to take much, much longer than even the local lockdowns. People are focusing on what's core to them. So I think a good place to know is like where not to start. And those kind of conversations can go on ad nauseam. So, if I was a founder, I would kind of go through the Rolodex of people who've really walked through my business in the last 2-3 years, understand me, the guys who've had, a quarter or once every 6 months touch in, guys who are thinking about maybe raising money from in, 6 or 12 months. Those are the people that you need to be kind of talking to and building a relationship with today now. Then I think the second thing, it obviously comes to what type of terms. Cost of risk has gone up. Valuations have gone down. I mean, I think across various markets, different markets reset at different expectations in terms of pricing. The US market, for example, very quick because of the amount of deals in the market. We find generally emerging markets actually reset pricing quite slowly. What that actually means is that founders who get ahead of the wagon and kind of engage early and are willing to kind of realize that there is a lot more security in having cash in the bank today and are willing to do that on terms that make sense are actually going to benefit. The guys who hold out for 6 or 12 months will be caught up in a whole big rush around that. It doesn't mean you have to kind of give up views around valuation, etc. But I do think that, this is when you need to start engaging your CFO and your team about kind of structured equity, etc. So either way, if you overperform over a period of time, you change the valuation retrospectively, or you have effectively a milestone-based payments where, you get something over the first 6 months, etc. It's all about ultimately is who's taking what risk. And so I'll give you a very clear example of what we're doing here at Apis is that we have businesses that say, look, we don't know how long Corona is going to go on for, 3 months, 6 months, 12 months, but we have a good business model and we're structurally advantaged and we want to take advantage of that. And so a very kind of transparent conversation between us and them is like, well, who is taking the Corona risk? If the economy, let's say, is 3 times worse than we expect, should we take that risk or do you want to take that risk? And ultimately, there's an impact on timing because the more you force an investor to take the risk, the more they're going to wait in terms of doing the timing. And so we've just been very clear with guys to say, well, look, we will deploy quickly if you're willing to internalize that risk. And what that means is you need to come up with a new business model that takes Corona into account. You need to put that in front of us and be clear about what the milestones and objectives you hit. And if you hit them, then we'll play catch up on the valuation later. And so we're happy to invest quickly in businesses that can outperform structurally through Corona and effectively move that along. And ultimately, each entrepreneur needs to make that trade-off themselves. But I would say if you think the investors are going to make that trade-off, what you'll find is that the funding rounds are going to drag. And now you may be in a position where that's actually something you can accept. Fine, then don't take the discount. But if it's not, it is just always about risk transfer and who's taking what risk. And there's always a legal way or contractual way to move those risks around in a way that optimizes what's most important for the business now.
What sort of, Nic, what sort of opportunities are you interested in? Or another way, at what point do you think would you start to look at opportunities in a more serious way?
So we're actually very active now. I mean, I think honestly for Apis Partners, this is a great time. I don't mean to be cavalier, but the benefit of being sector-specific experts, or let's say not experts, but let's say proclaimants of that, is that we do have a view on what business models we like. We do have a view on what business models are structurally aligned with kind of, let's say, the way economies are moving. And we think that, once Corona blows over, probably your business plan is 1 to 2 years behind where it was. But you're still there, right? And those are still kind of advantaged businesses. So right now we're investing in businesses we're very long on the online payment space. We're very long on the acquiring space. We're very long on the integration of various SMB tools. So whether you're an independent software vendor that's rolling in payments, or whether you're effectively a table-based POS, these are all things that we think are the direction of travel. And so we will be quite comfortably kind of invest there today without really worrying about it. I think what we do see, and again, this comes to, is that investors are retreating to their core. So this is our core, right? Emerging market financial services. Where we're not looking is where we were, let's say, in the past doing stuff like a bit more peripheral, micro insurance, business models that haven't really been proved yet. So even in our business, we're seeing that. And so, the same is true for, our peers who, let's say, were US-based funds investing globally. They're much more focused on the US market or the European market now than they would be on the African market.
Mm-hmm. And are you seeing any sort of interesting patterns between one emerging region and another? Any sort of synergies?
Not particularly. Look, I think the kind of trends that behind that were there before, especially in the payment space, are well embedded and aligned. If anyone looks at like FinTech investment, it's the reason everyone's on the call here, right? In the last several years, it's been kind of it's been well understood that this is a key trajectory and trend. I think where we are more focusing in about is like, what has COVID done that structurally changes business models that, let's say, weren't as advanced as, let's say, financial technology? Right. And so then we look at things like the digitization of education, government, healthcare. These are probably three areas where, from a regulatory perspective, there was too much red tape and inability of consumers to actually step into that we think would change, right? So if you were providing payments to those type of businesses, there may be new options to you. But I think that, like I said, COVID probably pushes everyone's business plan out 2 years, but doesn't change the nature of the travel.
Right, thank you. I'm going to move on to the last question and open up if anyone's got any questions. So if we look 1 year, maybe 2 years, however long this thing is going to go on for, you may have answered this already, Nic, but what do you feel that the landscape's going to look like for investment post that? You mentioned valuations are probably going to be suppressed somewhat. At what point do you think we're going to see a rebound? Do you think there's going to be a different appetite for investment? Obviously, Apis Partners is actively searching for opportunities. Is that the same across peers, across VCs, across angels? What are you seeing now, and how do you think that's going to change?
Yeah, so I think realistically, the way, obviously, if we take the big pools of capital, private equity, VC, high net worth individuals, the truth is for the two of those pools, so private equity and VC, most of the money has already been raised, right? And the truth is, I think that 2017 through to 2020 was maybe some of the best times in terms of raising capital in our industry. And many of those guys have not deployed. So there's a lot of dry powder, in fact, a record amount of dry powder that's sitting on kind of the sidelines. This is on a global basis. So I would say that, over the next 24 months to 30 months, deals will continue to be done. They will be more structured. There will be a different valuations. There will be capital to be deployed. Where you'll start to see a dip is probably, let's say, 24 months or 36 months there afterwards, because people who are raising money now in this market are going to battle. And those would have naturally been the people to deploy in like roughly 36 months. So that's why I think, now is a good time if you're an entrepreneur to get ahead of the race, kind of raise capital over those 24 months, because, our industry is going to struggle. We're always a lagging indicator in, 24, 30 months from now. And thereafter, depending on kind of the speed of the recovery and the depth of the recovery, we'll probably see a bit of a bounce back. I would say that this is global in nature. I think realistically that the truth is that a lot of GPs in Africa have struggled in the last 2-3 years. I think about kind of our peers at other private equity funds. Their returns have not been that strong. The ability to raise money in good times has not been that high. So, I would say that there's probably a decent amount of capital if you're raising $1 to $10 million. If you're looking to do more of that, that pool is quite small right now, I'd say.